Okay, hello and welcome to the Real Estate Rundown for March of 2024. Today, we're going to be talking about a few different topics that are coming up a lot in the real estate market lately. The first one of those is, let me jump ahead here just a second. So we have current market stats and forecasts. I came across some really cool market stats I'm excited to share. And then there's a few different opportunities in the market right now between a 5.99% coupon rate that Nova's doing, and downsizing with the reverse mortgage is another one that's coming up quite a bit. And I'm going to walk you through that. And then a few other ways that buyers and sellers are winning in this market. So my name is Daniel Jackson. I'm a loan officer here at Nova Home Loans. Part of my goal is to be a financial educator, which means sharing more information. And we come across a lot of news and different topics all the time. And so one of my goals is to share that with the clients and real estate agents that we work with. And so this webinar is a monthly event that we put on with that goal in mind. On my team, Joe Figueroa is here with me today, one of the loan officers on the team, Paul Boyson, and then Jennifer is our credit analyst. So that is our team. Now, just jumping right into it. So if you watched the State of the Union address last week, there was a lot of bold promises made about things that the government could do to get involved with the housing market to lower housing costs for working families. So just a few bullet points on that is and none of this is really has been put into place. So this is all just kind of speculation and political promises at this point, but there was a few different ones that were made that are interesting, and it'll be interesting to see if they actually happen or if something along the lines of any of these comes into reality. We'll see. But one of the things President Biden promised, well, here's 7 different things that President Biden promised, and basically providing a tax credit, a 2-year tax credit of $5,000 a year for first-time homebuyers. The second one was a one-time $10,000 tax credit, so basically the same amount. To the way it was worded in there says to middle-class families who sell their starter home to another owner occupant. And they define starter home as one that's below the median sales price for the area. So that sounds like a can of worms, but just to figure out whether or not you qualify. But cool nonetheless if it came into being. 25,000 down payment assistance to first generations buyers whose families have not benefited from the generational wealth building associated with homeownership. That's all spelled out in there. Lower closing costs for refinancing. They also promised to do something about lowering costs on mortgages. That'll be interesting to see what their plans are for that. It seems like anytime the government has gotten involved in trying to benefit the consumer over the last decade or two, it results in higher costs at the end of the day. But maybe there's some things they can do. We'll see. Building and renovating 2 million homes to close the housing supply gap. That will be interesting. And I bet something along those lines does come into being. They'll probably do some kind of incentives that will help home builders and developers build homes for a more affordable. There's definitely a lot of government fees, both state and city, county, and federal, that developers have to pay, and doing something to reduce those fees or to subsidize the fees in some way would probably go a long ways to closing the housing gap for affordable housing. And then all the rest of it was pretty much things about more tax credits, cost reductions for renters, landlord restrictions, and things like that. So, all right. This was a graphic I came across I thought was super interesting. The average down payment for a house state by state. Now, California has the top 3 priciest urban housing markets for down payment overall, being the San Jose area, San Francisco, the Bay Area, and then Los Angeles and Long Beach. So their average down payment on a house in California is about $84,000. When you compare that to Arizona, where we're at about $34,000, and we'll talk about a few different ways that people get into houses with really low down payments, less than $34,000 in a lot of cases in our area. But the overall national average is about $31,000. $31,500 is the average down payment on a house. Thought that was interesting. The median sales price is over $400,000, so that's it's less than 10%. Okay, now there's a few of these slides I'm going to share with you that on the market that came from Gary Keller's presentation at the Keller Williams, what do they call it? The family reunion event that just happened a week or two ago. And these are really great, I thought. And so I just thought I would share them. His whole presentation was like 80 slides long, and I'll share 5 or 6 of them with you here. Now, this just shows you the annual home sales, the number of homes that sell in the whole US each year, year by year. Now, that pink line that goes across, that's the long-term, or that's comparing last year's, just so you can kind of go back and see, all right, when's the last time we had home sales as low as we did last year? And it was in 2008, which was the last housing crash. I mean, big housing crash happened, and we got to right about the same level as in 2008. And then the first time it's ever been below that was 1995. So it's been a long time. Now, the projection for this year, the orange chart on the right, 4.3 million sales, is just a projection, but they're expecting it to go up a little bit this year. And I think they're probably right. Now, home prices, annual home prices, let me see if I can move this. Home prices obviously have been going up, but the long-term trend, if you look at this white line, this is a computer-generated trend line that says the long-term trend, homes tend to appreciate 4% on average. And whenever it goes above that trend line, like back in between 2005, 2006, 2007, you could see it got 24% above that trend line. And then we ended up with the market crash. Now, right now, we're about 9% above the trend. It says 9.3% above the trend line. So we still have a ways to go, but we are above the long-term trend. I think it's just going to come back down slowly, since we saw like very flat appreciation last year, maybe 1 or 2%. And we'll probably see something similar this year, between 1 to 5% appreciation. So I don't think we're going to see these huge appreciation numbers in the next year or two. So we'll probably get closer to that trend line. Another thing that is super interesting way of looking at this is batching. Now, ever since I've been in the mortgage business, I've always heard that real estate goes in 10-year cycles. The market is just cyclical. So you see the ups and the downs. Now, this just shows you appreciation rates and kind of broken down into different categories. Like between the 90s and 2000s, we saw a lot of super low, just the slow and steady if you look over here on the left, the 2.6, the 5%, the 4%, like right on the long-term trend. And then hyper fast growth between 2001 and 2005. And then we saw the crash and things going down. Now, if you look at this period between 2006 and 2011, there were some years with big depreciation where homes went down as much as 12.9% there in 2009. But overall, if you look at that period with the minuses and the pluses, the whole negative average was only minus 4.4%. So I thought I'd never seen it broken down like that. Then between 2012 and 19, average of 6.4%. So faster than normal recovery coming back out of that dip. And then between 20 and 22 was definitely a period of hyper inflation in the housing market, and we saw these huge appreciation rates. This shows in 2021 at 18% that homes went up on average, and in a lot of areas we saw like 30% appreciation in 1 year. Now, this is the first time I've seen it broken down like this, where we say, okay, 2023 and 2024, we're in a different market. Like we have shifted from the 2022 numbers, the 2020 to 22 numbers, and now we're in a completely different shifted market, and we're seeing these lower kind of flat markets. Total market volume, which what I wanted to show you on here is this white line, which is real estate agent count. Now, this is interesting to show you that, or when you look at this and you see that, okay, as market volume, so just that means the dollar volume of sales happening. Whenever we see markets like back here in the early 2000s where, okay, it's increasing, the number of people getting into the real estate business also increases along with it. And then as the business drops off and there's fewer sales to be had, then there's fewer agents in the market. And we've kind of seen that a little bit here, that over the last 10 or 15 years, we've seen this gradual build up and then kind of skyrocketing of number of real estate agents in the business. And then last year it started to dip and decline a little bit. So it'll be interesting to see that trend. I've heard the same thing happening in the mortgage business as well, as far as people renewing their mortgage origination licenses has gone down quite a bit. Now, taking a look at rates, and let's talk about rates for just a minute. The long-term average, we have mortgage rates. This is the Freddie Mac chart that goes back to 1970. And the long-term average 30-year fixed mortgage rate is 7.74%. Right now, we're at about 6.8. I think if we updated it as of last week's rates, it's 6.88, but 7.74. Now, if you look at just the average between 1990 and today, it's 5.98. So that's another interesting way to look at it, is the rates below, and a lot of economists are saying that when we see rates below 6%, then that's going to be a driver of a lot of buyers getting off the market or getting back into the market, and a lot of sellers deciding that, okay, now it's worth it to maybe sell my house and buy something else. Okay. Something else that now, housing is the cost of a house, how much it costs you to live in your house, whether you buy or rent, is one piece of everybody's budget, right? You have to pay for food and medical expenses, clothes, cars, everything, right? So inflation affects everything. And the Bureau of Labor Statistics breaks down the inflation into different categories. So I thought this was kind of a fascinating way of looking at inflation, of how much have things gone up in price since 2000. So just in the last 23 years, how much have things gone up? So if you start at the top, hospitality services, that would be like hotels and stuff like that, 238% inflation since 2023. College tuition's up 177%. Medical care services, 123%. I mean, that means over doubled. Average hourly wages, 93.8%. So, average hourly wages has almost doubled since 2000. Of course, average doesn't mean anything to the normal person, because you're making double or you're not. Housing at 88%, that's a big jump. And then new cars, household furnishings. And I thought it was kind of interesting to look at things that actually have gone down in price. Cell phone services, which I don't know how they calculate that, because I know like the new iPhone's $1,500 now. But overall, cell phone services costs are down. Computer software is down 71%. Toys are a lot cheaper, and TVs are a lot cheaper. Yeah, that's for sure. I think in 2000 I had a 32-inch old style TV. I was late getting into the flat screens, but yeah, I'm sure it costs as much as the current 80-inch flat screen. So anyway, TVs are half as cheap as they were in 2000. Okay, coming to our local market here in Yuma, if you look at the average sales price, this goes back to 2018. So that's the last, 6 or 7, 8 years. And if you look at what home prices have done here just in the last year and a half, it's been very flat. We've seen some ups and downs. There's months where the average price goes down and some where it goes up, but overall it's up maybe 1% from a year ago. But the number of homes that are selling is gradually or kind of steadily going down, and we're selling fewer homes, which is similar to the whole market as a whole in the US. Okay, home value forecast. Now we have 60 something years of data here, 63 years of data on the Yuma market that says that our average appreciation rate is 4.1%. So if you forecast that out, a house that you buy today for $286,000, which is our median sale price, the house that you buy today for that 5 years from now will be worth $342,000. Here's the rates at 6.88. One thing with mortgage rates is that until these inflation numbers cool off, the Federal Reserve really doesn't have any motivation to be cutting rates. They can't be, and this is a recent article that I just read the other day that says Powell reinforces position that the Fed is not ready to start cutting interest rates. I think it's going to be around June before we start seeing rates getting cut, and that's not directly impacting mortgage rates, but it will have a trickle down effect, and we'll start to see lower rates. As the election gets closer, And as the Fed starts cutting rates, we'll probably start seeing things come down a little bit. Now, something I want to point out, and then I'm going to show a couple of examples of some programs that we have and interest rates, is this question of what's my rate? Now, you can Google this. This is all public information, these things called the loan level price adjustments. So what it is based on how much you're putting down and what your credit score is and what your property type is and a few other factors, you might pay more or less for the mortgage than somebody else. So there's never just one given rate on any one given day. Over here, this is how lenders look at rates. And you can see on the day I pulled this was a week or two ago here, the lowest rate on the sheet was 4.75. And the highest rate went up to 7%. Now it's probably a little bit different, but at any rate, there's always a whole schedule of rates that we look at on any given day. And then based on your scenario, your rate might be higher or lower. And the rate that you take is going to be based on what you want to pay. So to get the 4.75 rate in this scenario that we pulled here, it was going to cost $12,780 in discount points of closing costs for the buyer. So nobody's going to want to take that deal. It's not going to be financially beneficial. At a 6.5 rate, you can see the cost is only $300. So that's more realistic. And then if you go up to a 7% rate, the cost is actually in the negative, meaning that the lender could give you a credit back to cover your discount points. Okay, so with that in mind, Nova just issued a coupon at 5.99%. So in certain cases where you can use this between now and the end of April, and that means you can get an interest rate of 5.99 on a 30-year fixed. So the caveat is it has to be a conventional loan, has to fund before April 29th, and it's going to have a 1% discount fee. Plus, if there's any of those loan level price adjustments, those will be applied as well. So let me just show you the base grid here. So if you have a 780 credit score and you're putting, say, this is on a purchase, so you're putting 25 to 30% down, then there would be no additional additions to the rate. You'd be at 0%. But if you had say a FICO score under 640 and you were putting 5% down, then it would be plus another 2.25 discount points. So you'd end up paying 3.25 in discount points in order to get that rate. It would be available to you, but the same exact program, 30-year fixed mortgage, because of your credit score and down payment combination, you'd pay some extra points. Now, how about refinances? We can use this for a refinance as well. So if you've done a loan in recent months and your rate is in the 7% range, then we could refinance you down to 5.99 on the same kind of deal. So depending on how much equity you have in the property and how much what your credit score is, then it's going to factor into how much it costs you to do that. So here's a quick example of how we figure out if it's worth it to refi. You always have to ask the question of, am I saving enough money to make it worthwhile of paying the cost? And when you're talking about discount points, those costs can really add up quickly. So let me just show you an option. So this $200,000 loan amount, let me move this here, or 200,000 property value, and you owe 158,000 on the loan, is currently paying 7%. So we look at this 5.9 coupon and we say, okay, we could refinance you to 5.99. Notice what happens to the loan amount is it gets increased because of those the LLPAs, the discount points and the closing costs on the refinance. Now, instead of owing 158,650, you're going to owe 162,000, but you get a 5.99 rate, which will drop your payment by $227 a month. So you have to kind of factor that out and say, okay, is it worth it to add what, $35 or $400,000 to my loan amount in order to save $200 a month? The other option that you could do is a no closing cost refi. This is something we usually try to put together for people, but if you'll notice, the interest rate's the same. So we could get you the no closing cost refi where it's not adding anything to your loan amount, but it's going to be the same, if not close to the same as what you're currently paying. So then you have to say, all right, is it really worth it to do it? Now, in this guy's case, we're going from a shorter term loan to a 30-year, so it's still saving $145. But the way to look at it is, okay, should I take the lower rate or should I take the lower cost? Is how long are you likely to keep that loan and how much is it going to save you over that time. So we have this analysis that we can run that gives us a cool chart and everything for a total cost analysis that says, okay, we're adding to the loan amount, we're restretching the loan out over 30 years, but we're saving you on monthly payment and we're saving you on interest. So over 24 months, you're going to come out ahead by $820 because of the interest savings and the monthly payment savings. Even when you factor in the amount that you're adding to your loan, you're still going to come out $820 ahead over 24 months. Now that grows obviously over time, especially with the lower interest rate. But when you compare that with the option of doing the no closing cost refi, in the short term, it actually saves you more money. You'll save $3,400 because you didn't add to your loan amount. You didn't pay all those upfront costs. But in the long run, so this, I stretch it out for 5 years instead of 2. And here you're going to pay about $47,000 in interest versus $61,000 that you're paying on your current loan. And the no closing cost refi, which saved you more money in the short term, once you stretch it out over 5 years, it's actually costing you about $6,000 more than the lower rate. So those are calculations that we have to do to figure out whether or not it's worth it to refinance. Now let's talk about downsizing with the reverse mortgage for just a minute. Here's a really cool example. So this is a 70-year-old couple that sells their house for $500,000 and they want to purchase a new home for $350,000. So you want to downsize and they don't want any monthly mortgage payment. So the traditional way that people do this is on the left here where it says, okay, we're going to sell your house for $500,000. You're going to pay about 5% in closing costs, which means you'll net out $475,000. You go buy a house for $350,000, and that leaves you with $125,000 of money in the bank. So, and you have no mortgage. Now, doing the same thing with the reverse mortgage, you get your house sold for the same price. You have the same closing costs, the same net proceeds. You buy that house for $350,000, but now we're able to take out a reverse mortgage loan for $182,700, which means you're putting down $173,000, and it leaves you with $307,000 of your funds in the bank. So instead of $125,000, you're left with $307,000 in your retirement funds, and you still have no monthly mortgage payment on the reverse mortgage. So pretty cool deal for those that qualify. You have to be at least 62, and the older you are, the more you'll qualify for on the reverse mortgage. Now, you can actually do the same thing even if you're not downsizing. In this market, it's more realistic sometimes for buying a house that's even more expensive. So, but the same thing works. And let me walk you through this. So same exact example here of selling your house for $500,000, netting out $475,000. But in this case, they want to buy a house for $700,000, which means they're going to have to pull $225,000 out of their other savings in order to pay cash for this house. So instead, we structure it with a reverse mortgage over here on the right. They're able to take out a reverse mortgage of $365,000 based on that $700,000 purchase price. Now they only need $334,600 for their down payment, which comes right out of the proceeds of the house. Remember, you're netting $475,000. So it's actually going to leave you with an extra $140,000 that you could deposit back into your savings instead of having to draw the money out. So when you're in retirement, it's really important to keep track of your money and not draw into your savings in ways that are going to impact you negatively in the long term. So the reverse mortgage can be a great solution for those types of situations. So if you know anybody that wants to look into that, then we should definitely at least run the numbers before making any big moves. Okay. Now let's talk something big that's happened or that's popular right now with the interest rates being what they are is doing home equity lines of credit. So with that 5.99 rate, we might avoid this in some cases because these HELOCs are based on the prime rate. So you end up with a 8.5 plus something rate. So in a lot of cases, they're as high as 11, 12, 13%. So, but the home equity line of credit allows you to take out up to 90% of your equity between $25,000 and $250,000 without having to mess with your first mortgage. So if you're on a nice low rate on your first and you don't want to mess with it, then this is a way of accessing your equity without having to refinance your loan. And we also have a second mortgage fixed rate. Instead of doing a home equity line of credit, there's a fixed rate option as well that allows you to get up to 80%. So if you have enough equity, we can do the second mortgage and access your equity as a fixed rate instead of a variable rate HELOC. So just something to think about. Another option, if you're wanting to buy a home before selling your old one, is a bridge loan program. So this basically allows us to pay off your existing mortgage on your house and get you enough money to put the down payment on the new house that you're buying. And that way you don't have to make a contingent offer on your new purchase. So even if your house is free and clear and you don't have a mortgage on the house that you're selling, you can still do the bridge loan to make your down payment on the new house if you want to. Really cool option for competing in this market. It seems like a lot of the houses go up for sale, and there's there's a lot of competitive offers depending on the area that you're in, and the good houses just tend to sell really fast, and the sellers a lot of times don't want to mess with an offer that's contingent on you selling your house. So if you run into that, this might be a solution we can look at. Down payment assistance is also another really great option. There's a lot of different programs in there. There's a $2,500 credit from Fannie Mae and Freddie Mac that they came out with recently to help low-income purchase borrowers. So in their case, this is what and now the income limits are county by county, but just looking at our local market here in Yuma, this is what it looks like. So to be in those income limits, depending on your family size, you'd need to be making $48,000 or less per year. If you're trying to sell your house, there's a couple of strategies that we can use to try to help more buyers to qualify for them and help you combat lowball offers. So let me walk you through this. So say you have a house and you're trying to sell your house for $350,000, and the buyer comes in and says, well, I'll give you $315,000 for it. So that means you're taking $35,000 less than you want for the house. And the net to the buyer, this is the way I think of it, is let's see, okay, what would it mean to the buyer if they got that deal? I mean, everybody wants to get a good deal, but what's the bottom line? Well, the bottom line is their monthly payment's going to drop. Instead of $2,195, it's going to be $1,975. So what's that? $220 a month? It saves them $220 a month, and it costs you as the seller $35,000. So an alternative solution is countering with something called a seller-funded buydown. So what you can do is offer to pay the discount points in order to buy down their interest rate permanently. So if you look at column 3, you counter back with an offer of $350. So you say, okay, I'll sell the house for $350, but I'll pay your discount points to get you a permanently lower interest rate. Instead of 7%, the buyer ends up with the rate of 5.875, and now their payment is $1,988, almost exactly what it would have been if they'd paid $315 for the house. As the seller, it costs you about $9,000 to do that in this example, and it has the same impact to the buyer. So pretty cool strategy, something to think about if you're selling your house. It might also help you if you're trying to buy a house and you don't quite qualify for the $350, you're only good up to $315. This is a way that you can try to stretch your qualification and qualify for the house that you want, is by making the offer for $350 and saying, but I need you to pay down my interest rate in order for me to qualify for your house at this price. And you can do the same thing. We've seen some really cool successes with that. Another thing that we really push right now, it's important if you're a home buyer, is getting a fully underwritten pre-approval before you go looking at houses. This way, we have something called the commitment to lend, which is you give us all your documentation and we submit your loan to underwriting, and we have a full approval on your loan before you even make offers on houses. That way you can tell the seller that you can close super quickly. All we need is to get the title work done, have the house appraised, and have you do your home inspections. And then as long as all that stuff is good, you could close really quickly. We've done some as fast as 9 days from contract to closing when you do this process. So it makes your offer look a lot more competitive, especially when a really good house comes on the market. You might be competing with a cash offer. And if you're able to close quickly without the contingencies of your loan not being approved yet, a lot of times that will help you to compete with offers. So, hey, Joe, do we have any questions or anything in the chat? Anything else we need to go over?
No, everything looks good. I think you covered it pretty well.
All right. Well, thanks everybody for being here, and please feel free to reach out. Here's the contact here. You could scan that and get our contact, but feel free to reach out if we can help you with your personal situation. And thanks again for coming, everybody. So long.